Hello, I'm Brent Kochuba, founder of SpotGamma, and I welcome you to the final video in our four-part educational series where we cover more advanced concepts that are key to providing the unique insights offered at SpotGamma. If this is your first exposure to SpotGamma, we are one of the world's leading resources for options market analytics and have been featured in Bloomberg, the Wall Street Journal, and many other top publications. At SpotGamma, currently, thousands of subscribers choose their level of access to our analytics. This ranges from twice daily commentary with dozens of critical data points to advanced plugins for futures traders that pushes real-time data to top trading platforms. It also includes technical levels and charts from more than 3,500 different stocks and ETFs. At SpotGamma, we are always working on additional metrics and products as we continue to grow our offering. Today we will cover a great deal of content, and I must first take a moment to remind all viewers that our goal is to provide you with unique information around stock movement based on our evaluation of the derivatives markets. SpotGamma is an information-only site, and nothing contained in any of these videos constitutes as investment advice. If you are going to be making any investments, please consult a professionally licensed investment advisor before making your independent decisions. Before we dive into the detailed review, we want to make sure you feel prepared to take advantage of the information in this video. In addition to this presentation, on our website, SpotGamma.com, we have 3 additional videos which have all been developed by SpotGamma as a primer to understanding stocks and options. To recap, in video 1, my colleague Matt covers the basics around stock trading. This includes a review of buying, short selling, and dynamics around orders and market participants. In video 2, Matt next covers options. This video describes the fundamentals of how options work. In video 3, I cover option pricing models and the Greeks. I review the inputs which most affect the price of an option. Our intent is for videos 1 to 3 to provide the basics required to understand the advanced concepts discussed in today's video. If these are all areas where you feel comfortable, that's great. Let's now look at the content we will cover today. During today's educational session, we will review our approach on a general and technical level, then cover a series of case studies. Please move at your own pace, and if you want to just hear examples, jump ahead to our case studies. On the next couple of slides, we will review our approach before getting into index and stock specifics. In terms of our approach at SpotGamma, our core belief is that over the short term, the stock market is driven by options hedging volumes. These hedging volumes are a response to significant trading volumes in the options markets. This dynamic has always been present. However, in recent years, the volume in options trading has grown significantly. You can see the increased volume illustrated here on the chart. This dynamic makes tracking, understanding, and analyzing where options are concentrated and how they will be hedged absolutely essential for an investor. Importantly, the impact of these flows can be meaningful for anyone interested in stocks, futures, or options. At SpotGamma, the data and analysis we provide to our subscribers does not require an advanced knowledge of these markets, calculus, or even the Greeks. We distill this information down into clear commentary, charts, and indicators which illustrate the impact of these dynamics. On our next slide, we describe our approach. Based on our perspective and experience, we have spent decades developing our proprietary approach. At SpotGamma, our daily process begins with analyzing current options positions, the recent trading volume, and how concentrated these positions are. Recall in SpotGamma educational video 2, we reviewed that market makers have to trade significant stock volumes against their options position as a hedge. It is these hedges which impact overall stock volumes and prices. Next, in video 3, we describe pricing with a Tesla option, and we will carry this forward into a more robust case study later in this discussion. So again, our first step is to review millions of current data points to identify and characterize current options volume within our models. Next, we compare this real-time data to our proprietary database. At SpotGamma, we process and maintain over 20 years of historical data and test our core modeling assumptions daily, meaning we continuously run backtests and simulations against our database to refine our core algos. This ensures we are translating our best thinking into actionable insights. Each day after updating our models, we then convert all of our output into digestible commentary, charts, and graphs for our subscribers. Translating sophisticated concepts into clear illustrations is at the core of what we do, and we will next define some of these models before reviewing case studies. As a last step, before we get into our examples, we will take a couple of minutes to describe a bit more about the Greeks. We discussed them at length in video 3, and here we are intending to describe the real-world application of 2 of the core Greeks, delta and gamma, and 2 additional Greeks, charm and Vanna. These 4 primary hedge adjustments revolve around the dynamic interchange of a stock and options price, volume, and large options expiration dates. Again, as a reminder, at SpotGamma, we model these data points to provide insights for major indices in over 3,500 different stocks and ETFs. Now let's discuss the Greeks tied to these hedging flows. First, for delta, this is the hedge adjustment related to an initial options position change. When a large option position is open or closed, market makers and dealers must immediately hedge these positions. Second, gamma is the hedge adjustment related to an underlying price change in the stock. As the price of the underlying stock or index changes, dealers may need to adjust their hedge position. Even for small changes in the underlying stock price, this may create changes in the required hedge ratio. Third, for charm, this is the hedge adjustment related to the decay of an options position. This means it takes a time value into account. Lastly, for Vanna, this is the hedge adjustment related to a change in implied volatility. We cover implied volatility in detail in video 3. Now that we have discussed our approach and the impact for key Greeks, we will move on to our case studies, which we believe clearly illustrate the potential impact options trading have on indices and stocks. Let's get into our case studies. These are meant as illustrations and feature situations which appear similar and may have different results. For our first example, let's take a look at the S&P 500. The S&P 500 is one of the largest stock indices in the world with over 11 trillion of assets linked to it. The S&P 500 is considered the benchmark index of the U.S. stock market. SpotGamma measures the amount of options gamma for each option across the S&P 500 index on a daily basis and then sums that gamma to create a value known as total market gamma. We call it the SG index. This metric gives our subscribers an estimated level of hedging flows for the S&P 500. Our SG market gamma indicator is provided each day to our members with a value of somewhere between -4 and +4. Recall back to video 3 where we discussed options gamma and the difference between positive and negative gamma. When our SG index is greater than 0, this indicates that market makers have a positive gamma position. Conversely, when the index is below 0, it implies they have a negative gamma option position. As this figure gets larger, it implies that the market makers have a larger options position and more to hedge. In other words, an SG index reading of 0.1 indicates that dealers have little hedging to do. But a reading of +2 or -2 indicates they have a sizable position which may have a large impact on stock market movement. Some of you may also heard of market gamma described as a notional value in the millions, but SpotGamma condenses this figure for easier interpretation. This positive versus negative gamma position is important as it implies market makers have to hedge in a different way. Take a look at the chart here on slide 7, which helps us to illustrate this point. The red shaded area shows the cumulative daily return of the S&P 500 when there is a positive gamma market, while the blue area shows the returns when the gamma is negative. You can see that the market has more volatility as gamma shifts more negatively. We believe the stark contrast in market returns is driven by the way that options dealers must hedge depending on if they have a negative or positive gamma position. You can see how being equipped with this information can be vital towards estimating the amount of movement or volatility in the market. By looking at the options dynamic around the S&P 500 and for individual stocks, we gain key insights into potential changes in stock volatility and direction. Let's now look at a very salient example during a time frame we have all recently experienced. While early indications of a virus shutting down factories in China and starting to spread across Europe was causing concern, it was not yet understood how dramatic an impact COVID-19 would have on the global economic landscape. However, sophisticated and informed investors in the options market began making moves and setting up positions before the vast majority of traditional stock traders and investors. In fact, we would argue that the options market started the downward crash in February and supported the base for a recovery in March. This is illustrated on this graph. In February, as a large number of calls expired on the third Friday of the month, which was February 21st, we would argue that just as negative news increased, the expiration of large call positions led dealers to unwind long stock hedges. Also, part of this equation were substantial put positions listed for March expiration. As the market collapsed under the weight of put buyers and dealers needing to sell stocks to hedge their positions, this created a domino or snowball effect where as the market went lower, dealers had to sell additional hedges which provided more downward pressure. Then, these large put option contracts expired on the third Friday of the month in March. This was March 20th. The market started to mount its recovery there and has led to new highs. At that low point, dealers no longer needed their short stock delta hedges and closed them, providing a vital buying force to markets. This illustrates an example of direct delta hedging. Also, the recovery resulted in a significant decrease in implied volatility, thereby reflecting a Vanna-based component to this rally as well. This led to a further unwind of short dealer hedges. The takeaway here is that investors who look only at the stock market see only one piece of the puzzle. One of SpotGamma's key metrics serves to alert our subscribers when the option market signals a possible change in market volatility. We were proud to alert our subscribers to the possibility of a large volatility change in February, and you can view our historical commentary on SpotGamma.com to review our notes from that period. As mentioned multiple times, we perform our analysis on the broader markets and indices as described here, and also on over 3,500 individual stocks. We will now walk through 3 additional case studies which convey the value of these insights. In case study 2, we will reveal an October to November example involving Intel Corporation, a tech company known for their semiconductor chips. They trade under the stock ticker INTC. On October 22nd, Intel posted a disappointing quarterly earnings update and the stock was down 10% the following day. This is reflected on the first chart on this slide. At SpotGamma, our individual equity model for Intel reflected a high level of put interest around the $50 strike, and this had an expiration date of November 20th. We believe that this put position would exert continued downward pressure on the stock due to the mechanics of dealer gamma hedging. This is represented also on our second chart, which is available in real time through our subscriber portal. While SpotGamma does not often write live individual stock analysis, we did write a note for our paid subscribers, and in this case shared it live via Twitter with our handle @SpotGamma. Please see the link to the note on the slide for your reference. We then saw the stock stay under pressure until November 20th expiration, after which time it lifted and traded back above the $50 strike level. This relief rally had elements of all 4 of the Greeks discussed in this video. This should be a clear example of a stock that was under technical pressure following a fundamental news release, where an equity, options, or futures trader would have benefited from the SpotGamma proprietary analysis. Let's look at another case study, this time in Tesla. Here we want to talk about Tesla and to describe in detail how SpotGamma's analysis provided helpful insights around the recent news concerning Tesla's addition to the S&P 500. On Monday, November 16, it was announced that Tesla would be added to the S&P 500 index. This news meant that millions of shares would have to be purchased on 12/18 by large funds that track the S&P 500. Knowing this, many traders sought to rush into the stock ahead of this large fund purchase. Overwhelmingly, traders used short-term call options to bet on a rise in Tesla stock. SpotGamma's models detected this increased options volume and was able to predict Tesla's movement with great accuracy. On Tuesday, November 17, SpotGamma's analysis was posted and sent out to subscribers detailing that because of the proliferation of options, the stock would likely pin the 500 price into the coming Friday's expiration. As you can see from the first chart below, Tesla was then trading at $460 per share and then shifted up to $500 into Friday's expiration, just as anticipated. We believe much of this lift in the stock was driven by dealers hedging options deltas, having to buy stock against their short calls. The following week, our options models detected that the largest options position had shifted up to the $600 strike. This indicated to us that the stock would draw up to this large options level and hold there until and unless the large option position changed strikes. Once again, the stock respected the large option position and pinned the 600 level for those 2 weeks as detailed in the chart. This pinning action is a great example of charm. As out-of-the-money options decay, dealers who are estimated to be short calls can unwind some of their long stock hedge position. This can keep pressure on a stock into a large expiration. Let's now look at one final equity example on the SpotGamma insights, considering the company Riot, which is involved in blockchain commerce. Having just covered a stock example with monthly impact following news and a weekly impact following news, I would like to cover another type of example, a stock situation where there is no news involved and is purely technical analysis. Remember, charm measures the hedge adjustment that needs to be considered relative to the passage of time, since an option decays more rapidly as it approaches its expiration date. In the case of Riot, a blockchain company, there are many speculative traders who get involved with the stock by buying weekly call options. They likely buy 1 week calls with the hope of expending a small amount of capital to make leveraged returns based on a very short-term upward move in stock price. Here, if you look at the chart of Riot, we note that each week for the past 3 weeks, the stock has weakened on Thursday and Friday as it approaches its weekly expiration. This is also reflected in the SpotGamma chart from 12/23, displaying the options impact. So the big takeaway in this example is that investors can use SpotGamma insights to help inform trades that are only a few days in nature, as well as void of any news or fundamental analysis. Having now covered stocks, options, and the Greeks, we hope this video drove home the value SpotGamma provides. We reviewed and illustrated 4 unique and meaningful trade examples where, again, the first example reflected huge options activity prior to a major move in the S&P. The second example reflected downward options pressure for a month on Intel stock following news. The third example reflected upwards options pressure and pinning for several weeks on Tesla. And the fourth example reflected downward weekly pressure on Riot stock with no news of any kind. Here at SpotGamma, we believe that without the type of insights we deliver, as an investor in today's market, you are missing critical information and potentially flying blind. I welcome you to join the thousands of subscribers who get our daily insights and analysis on over 3,500 different stocks and ETFs. You can do this by signing up for a free 5-day trial and joining our community. Thank you again for your time and attention, and best wishes for a successful investment approach.